Good morning. I'm Robert Mogensen from the Mortgage Advantage in North Vancouver. Today, the Bank of Canada announced a second unscheduled emergency rate cut in response to the COVID-19 pandemic, lowering its target for the overnight rate by 50 basis points to 0.25%. This is in addition to the bank's March 4th and 14th rate cuts of 50 basis points each. The bank now has cut the target for the overnight rate by 150 points in March alone. The bank's statement acknowledged the urgency of the situation in Canada, explaining it this way: the spread of COVID-19 is having serious consequences for Canadians and for the economy, as is the abrupt decline in world oil prices. So, what does that mean for you, the borrower? Well, it depends. Even though the Bank of Canada has now cut their target rate by 150 basis points this month, lenders have been increasing their fixed rates. This is due to the uncertainty and fear in the markets, with banks worried about liquidity and potential defaults. Now, if you currently have a variable mortgage rate in place, you're doing very well in the rate department, as these cuts by the Bank of Canada are all likely to be passed along to you over the coming weeks. If you're shopping for a new variable rate mortgage, however, you'll find that most lenders have now taken away their typical discount off the prime rate, or in many cases are actually charging a premium over and above the prime rate for exactly the same reasons that they're raising the fixed rate mortgages. Confused? Most borrowers are. If you'd like to know how these changes will impact your mortgage, please contact me for more additional information. I'd like to leave you with some information many of us have been wondering about lately: payment relief. Most banks and mortgage companies have now announced that during what looks like an uncertain period ahead, should you need a break from your monthly mortgage payments, they're willing to assist you. The gist of this offer is that with many lenders, you may miss up to 6 months of payments to offset a loss of income should you be laid off. The mechanics of this is that the lender will allow you to miss those payments and instead add the interest portion that you would otherwise have paid into the principal amount of your mortgage. Now, this is not free money. The interest portion will be capitalized into the amount you owe. So after the 6 months of missed payments, you will begin to pay it back with a portion of your normal payment, basically extending the amortization of your mortgage by a little over 6 months from where it sits today. Don't get me wrong, this is a great deal for a borrower if you really need it. If not, it adds to your interest costs and should be avoided. In other words, don't do it just because you can. If you'd like to discuss potential refinances, equity takeouts, or other mortgage-related issues, I'm always available to assist you as well. Feel free to reach out directly by phone or text at the number below, or find me online at robertmogensen.com. I'm Robert Mogensen from the Mortgage Advantage. Thanks for listening, and please stay safe, stay well.